In the early stages of wealth building, reliability beats lottery tickets. The math says, be average, because average in the stock market makes you rich. The problem with index investing isn't that it doesn't work. The problem is that it is incredibly boring. It provides zero dopamine. You buy a fund like VTI or VOO and nothing happens. No exciting earnings calls, no rocket ship emojis. Psychologically, we crave action. We want to feel like we are doing something to earn our wealth. This is why people trade options or day trade. They are paying fees and taking risks just to feel involved. If I am starting my strategy in 2026, I have to hack my own brain. I need to accept that good investing should feel like watching paint dry. If it is exciting, I am probably gambling. Here is the protocol, the core satellite approach. I put 90% of my investable cash into low-cost, broad market index funds. This is likely a mix of total US market and some international exposure. This is the core. It is automated. I never touch it. Then I take the remaining 10%, and strictly only 10%, and I allow myself to be stupid with it. This is the satellite. If I want to buy a specific tech stock or crypto, I do it here. If it goes to zero, my financial life is fine. If it goes to the moon, great. This scratches the itch to gamble without blowing up the plan. But where do I put this money? This is the next leak in the pipe. You can pick the perfect funds, automate your savings, and still lose 30% of your wealth. How? Taxes. If you are doing all of this in a standard brokerage account, you are volunteering to give the government a massive slice of your pie. Most people focus on the returns, but they ignore the net result. We need to talk about location, not where you live, but where your money lives. There is a belief that you should just open an app, link your bank, and start buying. That usually lands you in a taxable brokerage account. While these accounts are flexible, you can withdraw any time, they offer zero tax shelter. Every time you sell for a profit, you pay capital gains tax. Every dividend you receive, you get taxed. Over 30 years, that tax drag is enormous. If I am starting in 2026, I am looking at the tax code as a rulebook for wealth. The government gives us specific incentives to save for retirement, and ignoring them is expensive. I need to fill the tax-advantaged buckets first. Let's crunch the numbers on a Roth IRA versus a taxable account. Suppose you invest $10,000. It grows to $100,000 over 30 years. In a taxable account, when you withdraw that $90,000 of gain, you might owe 15 or 20% to the IRS. That is $18,000 gone. In a Roth IRA, provided you follow the rules, that withdrawal is tax-free. You keep the full $100,000. That $18,000 difference isn't due to better stock picking, it is purely due to account selection. And if you have an employer match on a 401k, that is literally a 100% immediate return. You cannot beat that math anywhere in the market. The resistance here is accessibility. People say, but Tom, I don't want to lock my money away until I'm 59 and a half. What if I want to retire early? This fear leads people to skip tax advantages in favor of liquidity. But here is the psychological twist. Locking the money away protects you from yourself. It prevents you from raiding your retirement fund to buy a boat or pay for a wedding. The penalty for early withdrawal acts as a behavioral guardrail. Plus, there are ways to access some of that money early if you really have to, like withdrawing Roth contributions. The fear of locking up money is often just a fear of commitment to the long term. The protocol is a waterfall. Step 1. 401k up to the employer match. This is free money. Step 2. Max out a Roth IRA. In 2026, The contribution limits will likely be higher, so check the current cap. This is tax-free growth. Step 3. If you have a high deductible health plan, max out the HSA. It is triple tax advantaged. Step 4. Go back to the 401k and fill it up. Only after all those buckets are full do I put a single cent into a taxable brokerage account. This order of operations creates a tax shield that accelerates your compounding significantly. But there is one final piece of the puzzle: the income. We have covered saving, investing, and taxes. But you can only cut your expenses so much. You can only optimize your taxes so far. There is a hard floor on spending, but there is no ceiling on earning. If you really want to accelerate this timeline, the spreadsheet won't save you. You need to look in the mirror. We are told that if we just stop buying lattes, we will be rich. This is the latte effect myth. Sure, wasteful spending is bad, but you cannot budget your way to wealth on a $30,000 salary in 2026. Inflation makes the cost of living a moving target. If I focus 100% of my energy on clipping coupons, I am playing a defensive game. Defense prevents you from losing, but offense is how you win. My strategy requires me to shift my mindset from "how do I save $5" to "how do I earn $5,000?" Consider the math of a side hustle versus a career pivot. Driving for a rideshare app might net you $20 an hour after expenses. It is linear income. You stop driving, you stop getting paid. But learning a high-leverage skill like data analysis, specialized sales, or technical coding can bump your primary salary by $20,000 or $30,000 a year, recurring. That salary bump counts for 401k matches, Social Security credits, and future raises. A 10% raise on a $50,000 salary is worth far more over a lifetime than a weekend gig. The math says to invest in your primary income engine first. The psychology here is tricky because learning new things is hard. It is easier to drive a car for cash than it is to take a certification course at night. We gravitate toward low-friction income. But low friction means low barrier to entry, which means low pay. If I am starting at zero, I have to embrace the discomfort of being a beginner again. I have to be willing to look stupid while I learn a new trade or skill. The comfort zone is where your financial dreams go to die. So, here is the final protocol: the skill audit. I look at my current job and ask, what is the one skill that, if I mastered it, would make me undeniable? Maybe it is public speaking. Maybe it is project management software. I dedicate 1 hour a day, the time I would have spent scrolling TikTok, to mastering that skill. I use free resources online. In 6 months, I use that new leverage to ask for a raise or apply for a higher tier role. Increasing your shovel, your income, makes every other step we discussed today work 10 times faster. A 20% savings rate on $100,000 is a lot more powerful than on $50,000. So, if I woke up in 2026 with $0, this is the exact playbook. 1. Kill the high-interest debt using the avalanche method. It is a guaranteed return. 2. Build the 3-month cash fortress to protect against life. 3. Open the tax-advantaged accounts, 401k and Roth IRA, and fill them using the waterfall method. 4. Invest primarily in boring, low-cost index funds, keeping the gambling to a tiny sliver of the portfolio. And 5. Aggressively upgrade my primary skill set to increase my income. It isn't sexy. It isn't a get-rich-quick scheme. It is a get-wealthy-for-sure scheme. I've run these numbers 1,000 ways, and they always point back to these fundamentals. But personal finance is personal. Maybe you have a different take on the debt payoff, or you prefer a different asset allocation. I want to hear it. Drop your strategy in the comments. I read them to see where I might be missing a blind spot. If you found value in this breakdown, consider subscribing. It helps me keep the lights on and the spreadsheets running. Thanks for watching, and I'll see you in the next one.